For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future. Welcome back to the podcast. Thanks for joining us. Wow. Johnny Dean here with Professor Rick Plum, Certified Financial Planner Professional, CFP. Hello, Rick.
Good morning, good afternoon, good evening.
Yeah, we don't know what time it is. We're just here in the dark studio doing our thing. It is Managing Your Financial Future, and we do appreciate everybody who listens and tunes in. We got a bunch of new listeners, I know, folks that we hear from. I should mention, too, when we start the podcast, we usually record these and then it goes through compliance.
Yes.
There's a process. So we record these a couple of weeks, maybe 3 weeks in some instances before they air. So if you have comments,
it may take a little time.
It may take a few weeks before we actually address them on the air. So I should throw that in. We had one. I'm going to address this here if you can, because other people may have had this question come up as well. This was from a few episodes ago, but I thank John for sending this in Oregon, who was talking about, we had a podcast on 401ks and 401k contributions and all that stuff. And his comment was, your recent talk about 401k did not mention benefits of pre-tax contributions. A person putting 6% pre-tax into that 401k only ends up having a 4 or 5% reduction in take-home pay, depending on their pay, but they get matched on the pre-tax amount, a double bonus, and not so bad for current cash flow. So thank you, John. In other words, I think what he said, we didn't emphasize the point
of the pre-tax. And one of the discussion points was, should we be doing pre-tax or more Roth 401k,
yes,
where you do not get the deduction?
Yes.
So if you're putting 6% into the Roth 401k, it's 6% out of your paycheck.
It absolutely is.
Where if you're putting 6% into the traditional 401k, again, depending upon how much you make during the year, it may only be 4.5%, 5% reduction in your paycheck. So you get a little bit of it doesn't go down as much as you're actually contributing. But there's also the other side to that. When you take the money out, it'll be taxable then.
Yes.
And so we do have to look at both sides. And when we talk about the 401k versus the Roth, to be honest, I don't care which way you go, just save. One way or the other. You can't go wrong saving, whether it's 401k traditional or 401k Roth. It's kind of like voting in Chicago. Save early, save often, do it all the time. Just keep saving. But if you're looking at it, is the tax deduction today better than the taxable event in the future? If the taxes are going to be lower in the future for you in that particular issue, then the tax deduction today is worth tremendously more. On the other hand, if your taxes are going to be higher, and we were going through this with somebody just the other day, and we were trying to decide whether we're doing 401k traditional or Roth, and it had a lot to do with where they are, at what age. I think they were 51, if I remember rightly. And they had a decent portfolio, but only 25% of it was tax deferred. So they'd been saving up quite a bit anyway. So now they've gotten a new job. Their income went up quite a bit. They're in a reasonable, not the highest, but a decent tax bracket. And so what became more important? We looked at if they contributed their full $30,000 a year to the 401k side, the traditional, they got a tax deduction, yes. But then they were going to have to pay taxes on it later. So we kind of tried to make an idea of what would this potential grow to and see how much income it was going to create in retirement and look at what the potential tax brackets would be in retirement. And in their case, it made sense to do the tax deductible one because they're in a much higher bracket today than they will be in the future. They're playing some catch up. On the other hand, I worked with somebody else a week or two ago where the majority of their savings was already all pre-tax. And so they were going to, and if they keep doing their $30,000 a year into the pre-tax side of things, their retirement income was going to be basically 100% taxable, which obviously creates an issue for the Social Security taxable benefits. And it looked like their taxes are going to be higher in retirement than it would be today. And so they were looking to do more Roth 401k.
Yeah, so what it comes down to...
So we do have to look at both sides. Yes, it does feel better today to do the traditional side because we get that tax deduction. It feels like we're getting a benefit because we are of saving and tax deductible, and we can put away money without having the full impact felt on our pocket right away.
Net pay, yeah.
But we also have to look at what is that creating. I also know people that no matter what, you can say, look at your tax bill in retirement is going to stink. You are going to be in a massive tax bill in retirement, much worse than what you're paying today. Nope, I'm going to do the deduction. It's like, wait a minute. Hey, it's your money. As long as you're saving and you're taking care of yourself, I don't care.
So the whole point of that is we have to look at both sides. And I think that was what the focus of our podcast was. How do you decide? Well, you need to look at the deduction now versus paying the taxes.
But
later,
it does feel much better doing the deductible side.
It does.
When you put in 6, 8, 10, whatever you're putting in, but it doesn't, your check didn't go down by that much.
Yeah.
That sure feels good. And, whether you're putting in 6% to the Roth or putting in 6% to the traditional, if they're matching on the full contribution, not the effect in your tax, in your take-home pay.
Sure.
Which is wonderful.
It is
Get
wonderful.
The matching, save. I said that earlier. Save. And get that matching contribution. That's part of what they're willing to pay you. Get your pay.
Otherwise, they keep it.
Yeah, they've agreed to give you that money for working for them.
I think that was a good point that we mentioned on that particular podcast. Anyway, thank you, John, for that. Just remember everybody should remember that on the traditional side, there's the other part of it, which is taking the money out. So always good to hear from folks. And again, if you want to email us, you have questions on things that you hear, just understand that it may take us a couple weeks to address them on the show. So let's get to the topic at hand, which is not 401ks. For people who are tuning in, they happen to notice that it has to do with the bucket strategy and interest rates. Now, interest rates...
Now that we have an interest rate that's actually being paid?
Well, we do. I mean, this is really something that this was dormant for years and years.
A couple of years ago, on a bank account, 0.05, well, I guess brick and mortar banks are still there, but
they are.
Even the online banks were 0.5%.
Yeah.
And now they're 4.25%, 4.5%, somewhere, north of 4%.
Right. So where are we? We're well over a year and a half maybe into the whole interest rate increase.
Yeah,
right?
it's been nice, which has made funding and filling, I should say, bucket number one. Bucket number one is the low volatility or no volatility money, safe, liquid, available, that we're going to distribute principal and interest for cash flow for the next 5, 6, 7, 8 years, depending upon how aggressive or non-aggressive you want to be. 5, 6, 7, or 3 years ago, you'd be lucky to get 1%, 1.5 to 2% out of bucket number one to get safety and liquidity. Now it looks like between laddering in T-bills, CDs, maybe even a fixed annuity that's out there, get 4 or 5 years.
Much better than that.
You're going to get 4.5 or so or better, and that's a big difference. So bucket number one has become significantly easier, so to speak, and people are really happy with 4% on safe money.
Well, they are, but here's the other part of that, though, Rick, and that has to do with in a bucket strategy. The bucket one is really not there for rate of return. I mean, the rate of return is gravy, and it's nice, but it's certainly not vital. As we saw over the 10, 11, 12 years, that interest rates were near nothing. It became harder to convince people during that particular time, I think, to put some money in something that's not earning anything instead of jumping it all into a bucket three and going for broke.
Right. But as a retiree, if you look at any particular year, even years where the market is positive, at some point during that year, in almost every situation, there was a negative portion to that year.
Yeah.
And it was not a comfortable negative. And that's where, when people are taking distributions from a portfolio, that's where the value of bucket number one comes in. Yeah, like you said, the value of bucket number one is not in the great rate of return that it's giving us. I mean, really, is 4% that great? 5% that great of a rate of return? It's much better than it was 2 years ago. But the value is in the ability to continue to withdraw a certain amount of money, regardless of what the market is doing in that month, that week, that year.
The value is the time that it gives you.
The value is the safety and the time.
Time. It buys you time is exactly what it does. If it gives you a little better rate of return than a few years ago, great.
Obviously, we try to get the best rate of return we can out of it.
Well, because that can buy you more time, potentially.
But usually when we have interest rates, we have a little inflation too.
It's across the board.
Because we didn't have any inflation when we had the zero, basically interest rates.
Yeah.
Now we have You know,
a little. It's not bad. It's come down.
It's come down some, but we're still paying more than we used to.
So my question is, and the topic here is, how has the bucket strategy changed since interest rates have gone up, or has it changed? Because again, the basic principle of buckets is you use bucket one for the time that it can buy you. Forget the interest rate. I mean, that's it. You have bucket two, which can buy you time, but also maybe give you a little bit better interest rate because you've got the extra amount of time.
We don't have to be totally liquid. We don't have to be completely risk-free.
You can earn something on that.
So you can, and it's a little bit longer time horizon, so we can try to get a little bit better rate of return. And then bucket number three is the long-term growth.
Okay, so how have you seen this change? Has it changed since interest rates have come up? Or are you still doing the type of bucket strategy that you've always done?
Yes and no. We are still doing buckets the way we've always done buckets. It's just that how you go about funding it. And the problem is perception and what people want and what people expect have changed. And so we still want to have that first bucket to provide for a stable cash flow for 5, 6, 7 years, because nobody knows what the market's going to do. We're surprised by what it did this year. We were somewhat surprised at the beginning and then realized, okay, in 2022, it's going down. It's about time, But at late 2021, everybody was like, no end to the market in sight.
Oh, it was hitting all-time highs.
And but this is the biggest problem with the buckets, or with any investing, or not the buckets, the investing perception. So we still do the buckets the same way. Bucket number one, safe, reliable, liquid. Bucket number two, less liquid potentially, but not as risky as the stock market as a whole. And so what has changed the most is bucket two, I think. That's really the hardest bucket. For a while, the hardest bucket was one, because it was earning nothing, basically. And to get people to put enough money in there to avoid the downturns that inevitably happen was just no fun.
So they didn't want a bucket one.
They didn't want much of a bucket one.
Why am I, the stock market's hitting highs. Why am I?
Well, they weren't so more at the stock market. They were looking at, and the bonds weren't paying anything either, but they were looking at, I can get a dividend paying stock portfolio that pays me 2 or 3%. Why would I want to put money in a 1% bank account?
And
CD?
They were asking that as a way to take income from just
for
take
bucket
the
number
dividends?
one, because value stocks or any kind of dividend stock also have volatility. Yeah. It happens. And so when it goes down, things unfortunately happen, and you got it. When bucket number one, we're not living on the cash flow that it's earning by itself. We're living on a distribution of principal and the cash flow that it's earning. So we're selling the principal to create the cash flow. If you want $50,000 a year, we're not putting in $1 million into bucket number one if it's earning 5% to get that $50,000 a year. We're buying 7 years worth of time, so we're putting maybe $330,000, $340,000 in there to get that distribution of $50,000 for the next 7 years. That was not exact math, but relatively close. Mm-hmm. And then we're refilling it 7 years from now with bucket number two, and so we are selling the principal asset. So we want that principal to be sure. Whereas a value or a dividend paying stock, they go up and down. And so in the months where the markets are up, fine. I'm selling it at a premium. That's not bad. In the months where the market's down, that doesn't work for bucket number one.
Which is why you did not.
Which is why we don't use that for bucket number one.
All right. So buckets as a strategy.
Buckets as a strategy hasn't changed, but the funding of it and what people want out of it have changed. Bucket number one is much easier now than it was 2-3 years ago because it's paying 4% plus.
You can convince people it's a better idea.
Well, they're more comfortable. They're actually earning something, and we've been lulled into this thing where bank accounts earn nothing for so long. Even 4% seems like manna from heaven. It's like the greatest thing in the world, and it is much nicer than it used to be.
Yes.
But the problem is then bucket number two. Bucket number two, our expectations of bucket number two are somewhere between 4 to 6, 7%.
Has that always been that way?
That's the way it's been for quite a while.
Since interest rates went down.
Because we don't have the pure market return, because we're tempering it a little bit, and we're taking a little more risk than what just the pure T-bill return is going to be. And that might be the problem. People see T-bills at 5%, 4.5%, and they're saying, well, why don't I just use T-bills for bucket number two?
Like the entire...
Well, you could, but the longer you go out and lock it in, the lower the interest rate. If you look at the best interest rates when I was looking at them was in the 6-month to 18-month time horizon. After that, they start coming down. The 5 year is lower than the 2 year. The 10 year is lower than the 5 year.
Inverted curve.
Yeah, very much so. And so we can't lock in that rate for all the way. Now, we can lock in 4%, but I really don't want just a 4% rate of return out of my bucket of 2. I really would like to get something north of 4, 5, 6, 7 type ring. We're not going to get the 10, 12, 15%, at least we don't expect to, because we don't have 100% stocks. And even stocks don't always do 10%.
So during the low interest rate periods, what would you say just generally comprised bucket 2?
Well, it's pretty much the same stuff that's there now. It's just a little bit different way of handling it. Balanced portfolios, stock bond portfolios, I think they work okay now. They've got a little bit of interest on the balanced portfolios or stock and bond mix managed together. The reinvesting of the interest, the reinvesting of the dividends helps temper the up and down movement, but they have some volatility to them.
So a balanced type portfolio.
It can still work, yes.
Okay.
There are structured notes, structured products where you can invest and you can get some kind of buffer or some kind of downside protection. So basically, it's like an index account where you look at it point A to point B, usually a year period of time, sometimes 2, 3, 4, 5 year periods of time. Where is the index? S&P, Russell, EFA. There are multiple different indexes. Where's the index today? Where is it at the end of the measuring period? And the measuring period, as I mentioned, can be a year, 2 years, 3 years, 6 years. Is it positive?
So you use these products.
We use these products because if you're working on the market and you're working on a 7-8 year time horizon, bucket number 1, it lasts for 6, 7, 8 years. You can sit there and say, well, if the market's positive, I can get 10, 12, 14% of the upside.
Just as an example.
And if the market's negative, I'm not actually invested in the market. I'm invested in this structured product. The first 10% doesn't hurt me. This is just a generic way of looking at it. There's lots of little nuances with these.
Yeah.
And so if the market goes down year over year, like it did in 2022, so the market was down 18%, the S&P 500. If you had a 10% buffer and you had just that 1 year, because they don't go on calendar year, they go on contract year.
Okay, yeah.
I know what the calendar year number was. It was down 18%. So you had a 10% buffer. The first 10 didn't hurt you. You were down 8.
When the market was down, when the S&P was down 8.
And then on the upside, you don't get if the market goes up 30%, you don't get the 30. You get 12, 15, 18% on the upside.
So these are bucket type 2.
But it helps the downside volatility, but still gives you some upside volatility. If you figure you got a negative. So, it's just, those are what helps. For the more conservative investor, a fixed index contract where the upside is less, may only be 8, 9, 10% at the most in today's world, but the downside is 0. You can't lose money. So depending upon how we're doing, so balanced portfolios, these kind of, there's lots of these buffered notes. There are buffered note portfolios that do them every month and they're rolling and they make it easier in some respects. They're more liquid. There are lots of these things out there and they work fairly well for bucket number 2, but they've always worked fairly well for bucket number 2. It was just that the upside expectation was less. Downside was about the same protection.
What do you mean the upside expectation was less on whose part?
Well, on the investor's part and on the contract's part.
The upside meaning because the
interest rates were so low.
Yeah, okay.
The upside may have been 8, 9% with the 10% buffer. Now they're 14, 15% with the downside buffer. The upside on the fixed contracts where you couldn't lose any money was maybe 4.5%, and now the upside is 9%. And so with no risk of principal in those types of contracts.
Again, these are insurance products.
Not always.
What these are, right?
Not always. Some are notes. Some are notes issued by banks.
Okay, so these are backed by, in some cases,
they're backed by an insurance company. They're backed by a bank. There are some that are principal protected that even have FDIC insurance. Obviously, the more protection you have, whether it be a pure protection or an FDIC, the upside is going to be more limited. If you go from a 10% buffer to a 20% buffer, meaning the first 10% doesn't hurt you or the first 20% doesn't hurt you, that 20% buffer is going to have less of an upside. The more protection, the less upside. The less protection, the better the upside. And like I said, they can be insurance companies backing them, they can be banks backing them and issuing them. They can be indexes or they can be baskets of stocks. There's a lot of these things out there, and so you just have to understand a little bit about what you're investing in, so you know what to expect and what the holding period is. How long is it going to be tied up that you can't get to it because of a surrender charge or contingent deferred sales charge.
Well, since this is a bucket 2 deal, I mean,
Right.
you presumably don't need this for a minimum of 7 to 8 years.
Right. The whole idea is we've set up bucket number 1 to buy time. Great term you used earlier. And now we don't have to be perfectly liquid on bucket number 2. We don't have to have pure protection on bucket number 2. We can take a little bit to try to get that better rate of return. We try to get that, 7% or so, maybe, Lord willing, even higher. Who knows? But that's where bucket number 2 is. So bucket number 2 has been harder. And a lot of people now, with the market the way it was, are saying, we're already down. Well, now we've come back quite a bit. Do we really need bucket number 2? Can we rely on bucket number 3 more? Because if we're already down, the idea of buckets is to protect us against the downward movement. We're already down. So do we need the protection anymore?
Is it a market timing game or what?
That's what that's what some people are looking at.
Oh, boy.
Since the market's already down, we don't have to protect against being down because we're down. So let's go for more growth. And so they increase their exposure to the equities when the market's down. I don't necessarily have a problem with that. I just want to make sure I have enough bucket 1 and some bucket number 2 to give me some time horizon. Bucket number 3 has always been the easiest one because bucket number 3 is the long-term investment. And long-term investment, stock market, piece of cake. To me.
Well,
it could be the S&P 500, although even the S&P 500 has its issues at times. And part of it is the S&P 500 is the 500 biggest stocks in the U.S. But not every one of those 500 stocks has a good outlook. I mean, there's still brick and mortar retail in there. You think they're going to do well?
When you analyze that.
But even so, you can use these indexes. You can use a portfolio, and you've got a 15-year time horizon to let the markets work for you. So the bucket number 3 has been fairly straightforward. It hasn't changed much. Even the long-term expectation, when we had years, 2020 was up 20%, 2021 it was up 31%. People still thought 10% is a good expectation.
Okay, good.
And then a downturn of 18 in the S&P in 2022, and then an upturn this year. People, their anticipation, their expectations of bucket number 3 have stayed relatively constant. At least that's what I've seen from people. It's the expectation of bucket 1 and 2 that have changed
since interest rates.
Because with interest rates in the 4.5, they expect bucket number 2 to do much better. Well, they're not going to do significantly better, because if you do much better, now you're in the stock world. And so if your expectation for bucket number 3, your long-term growth is 9-10%, and your expectation of your bucket number 1 is 4.5-5%, well, you can't expect bucket number 2 to do 10%, because that's the only way you're getting that is pure stocks. And you've already agreed with that.
So the bucket strategy hasn't changed.
No.
With interest rates having changed, what you're saying is that people's expectations have changed.
Very much so. And that's the issue with investing in all across the board.
Well, so what do you do with that, though? As people's expectations change, they say, well, I expect more out of my bucket 2. I'd rather just, shorten my bucket 2 and put more of a bucket 3 type.
Well, as financial counselors, it is our job to help people become more realistic with their expectations.
Yes.
Try to, but in the bottom, it's their money. They can do whatever the heck they want with it.
Well, of course.
But we try to make sure that the expectations are in line with reality, what we think is reality. Obviously, the future isn't here. We don't know exactly what's going to happen in the future. Nobody can predict it. But we have a pretty good idea over the longer terms of what is going to happen. It's the shorter terms that nobody knows anything about.
I've heard the secret to success in investing, if we want to call it a secret, the key, let's say, to success in investing is not screwing up consistently. I mean, don't worry about getting high returns every year, because you won't. Just get
you
decent
hit home runs every time.
Just get average to above average returns, but sustain them over a long period of time. That, to me, speaks volumes.
But even that, you're not going to sustain it forever and ever, because if you stay in the stock market long enough, you're going to have a bad year. Mm-hmm. And unfortunately, when people have a bad year, this is where psychology takes over, and people tend to move out of the market at the wrong time. You're right in the way you're doing it. Expect and look at your long-term rate of return, and don't jump in and don't jump out. Don't believe that you are smarter than the world and you can time when to get in. And because when you time the market, you have to be right twice. Basically, when I'm looking at the market, it's going up and up, and I think that it's at an all-time high, so I'm going to market time it, and I pick the time and I pull out of the market, and lo and behold, I am right, and the market dives after that, it goes into correction. I now have to be right again by putting it back in at the right time. I know a lot of people who have pulled out of the market near a high, either just before or just after the market high, but they didn't get back into it until it had already recovered to that point or higher.
Yeah,
it happens.
It happens, and it's once again the emotional part of it. It's the expectations.
And for somebody who's working, it's much easier to handle that because we're investing through our 401ks, maybe our IRAs on a systematic basis.
We don't think
I do
about
like
it.
Systematic, and we're investing right through the highs and right through the lows.
Yeah,
we're getting the advantage of ups and downs. Invest early, invest often, just keep doing it. But for a retiree, we have to understand when we're expecting it. So as I mentioned earlier, buckets is a way to help mitigate the risk of retiring into a downturn market in the not too distant future. But that doesn't mean it's going to be down. It's there to protect. But it doesn't mean that you always need that protection. But you also have to then look for opportunities. Opportunities are when the market is up better than expected. The idea of bucket number one is to protect you from the market being down unexpectedly, or, I don't know if you want to say expectedly. We expect it to go down at some point. We just can't time when. So bucket number one is there to get us through at least a chunk of that. And then bucket number two will take over. But that doesn't mean that it's always going to be bad. Volatility goes both ways. Negative, which is what we're trying to protect against, and positive. That's where you have to take advantage of the volatility that the market gives you. The positive volatility of the market. That's when you're selling in 2020. You're selling in 2021
at the
before
end.
You get to the downturn.
Yes.
And so when the market is higher than expected, take a little gravy off the top. When the market's lower than expected, you have time to wait it out, or take some of that money that you sold off earlier if you did, and maybe you can invest in at that time.
Well, you're talking about, again, buying time. You're saying...
I'm talking about value averaging and using the buckets the way they were intended.
To extend...
To protect against downturns and to identify positive upturns better than expected.
Well, because when it comes right down to it, I think what people want is enough money coming in.
They want enough money coming in, and they don't want to have to worry about it.
They want an income they don't want to have to worry about, which is why you do the whole
That's
bucket
the buckets
strategy.
idea, yes.
So it hasn't changed. To answer the question of the topic, it hasn't changed. The structure of buckets hasn't changed. What has changed is your
where people focus,
managing people's expectations.
It used to be bucket number one was horrible, bucket number two is easier. Now it's bucket number one is great, bucket number two is horrible. They're the same, basically. Everything's relative to where we were before.
It's all cyclical. If you need your bucket strategy looked at, or if you'd like to get a bucket strategy because you don't have one, well, you know what? Talk to the folks at Lucia Capital Group. Professor Plum is the Chief Financial Planning Officer at Lucia Capital Group. So Professor Plum works with all these people to help put these plans together. 800-644-1150, the number at Lucia Capital Group. 800-644-1150, our long, and I mean long-time sponsor. And we talk about buckets because, frankly, as we saw during the downturn of 2022, people look at it and say, "Oh, that's why I do buckets."
It becomes much more,
now I remember.
Much clearer why we do it when we have the downturns. When the market's just going on fire, people forget about risk.
Yeah.
But when risk rears its ugly head, oh yeah, that's why we did. That's why we didn't drive 140 miles an hour. We only did 55 or 65.
Sure, if you're driving 70 and you see a train going by or a car going by at 100 miles an hour, well, why aren't I? Look how far up they are. Of course, they break down.
Yeah, or they get a ticket.
They get a ticket, or they're off to the side, and next thing you know, you're just passing them by.
Yeah.
And that's the whole point. Slow and steady wins the race. But convincing people of that can take some psychological
counseling,
and that's what it's for. Again, 800-644-1150, or go online, LuciaCap, LuciaCap.com. Send us an email if you'd like, and we'll try to get to it as quickly as we can. If there are things on certain programs that you would like to see addressed or questions you have about any of these programs, go ahead and email us, and then we will, if it's compelling and it works for us, we will certainly address it on a future program. Don't forget to subscribe to our podcast. Go to Spotify. You can also do it on iTunes via Apple. Any way you can. Don't miss this episode, any episodes. We're almost at 150 so far, so go back and you can listen to previous episodes as well. Subscribe and don't miss a single one. Professor Plum, thank you so much.
Welcome.
Appreciate it. We got more coming up, and stay tuned for more. For Professor Rick Plum, CFP, Certified Financial Planner Professional, I am your non-advisor, Johnny Dean, but podcast host. Thanks again. We will talk to you next week.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the information presented serves as the receipt of or a substitute for personalized advice from Lucia Capital Group or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. Distributions of principal from a Roth 401k are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth 401k was established, whichever is longer. Your investment options are limited with a Roth 401k to those offered by the plan administrator. Charges and fees may be incurred. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. A value averaging strategy does not guarantee a profit or protection from loss. The investor sets a target growth rate or amount on his or her asset base or portfolio each month and then adjusts the next month's contribution according to the relative gain or shortfall made on the original asset base. Since such an investment plan involves continual investment in securities, you must consider your willingness to continue purchasing during periods of high or low price levels. It is important to keep in mind that investments in fixed income products are subject to liquidity risk, interest rate risk, financial risk, inflation risk, and special tax liabilities. Interest may be subject to the alternative minimum tax. Treasury securities are backed by the full faith and credit of the U.S. government but are subject to inflation risk. CDs are FDIC insured up to $250,000 per depositor per insured bank for each account ownership category. Information on investment products is for informational purposes only and does not constitute an investment recommendation or a solicitation to buy or sell the investment products described herein. Any investments or strategies referenced herein do not consider the investment objectives, financial situation, or particular needs of any specific person. Product suitability must be independently determined for each individual investor. Structured notes, equity index annuities, and variable annuities are considered complex investment products. They contain unique features, risks, terms, conditions, fees, charges, and expenses. Fixed index annuities are complex long-term investments designed for retirement purposes. Guarantees are based on the claims-paying ability of the issuer, subject to their terms and conditions. Generally, returns are based on a market index and are limited such that an investor does not fully participate in market performance. Withdrawals may be subject to surrender penalties or foregoing benefits if withdrawn prior to the contract term. Investors should speak with a financial professional about the contract's features, benefits, risks, and fees, and whether the contract is appropriate for the investor based upon his or her financial situation and objectives. Withdrawals prior to age 59.5 may be subject to a 10% penalty tax in addition to income tax. Annuities are not FDIC insured. Certain terms and conditions apply, so please read insurance company materials carefully. S&P 500 Index is an unmanaged index and includes a representative sample of large-cap U.S. companies in leading industries. An investment may not be made directly in an index. Russell 2000 Index is a small-cap index consisting of the smallest 2,000 companies in the Russell 3000 Index, representing approximately 8% of the Russell 3000 total market capitalization. An investment may not be made directly in an index. Rick Plum is a registered representative with, and security and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.